welcome to the show where we share the stories of the many who intersect with our healthcare system but are rarely heard from. My name is Kevin Poe, founder and editor of KevinMD. Today we have a special sponsored episode. We welcome back to the show Syed Nishat. He is a partner at the Wall Street Alliance Group. He is a regular contributor for KevinMD, and his articles and interviews about asset protection and common financial mistakes by physicians are published in MedPage Today and Medical Economics. He is regularly quoted and interviewed in media outlets like Forbes, U.S. News, and Yahoo Finance, and he can be reached at wallstreetag.com. That's wallstreetag.com. And today we're going to talk about a very relevant topic: tax planning tips for physicians. I just did my taxes last week, and I'm certainly interested in hearing more tips around tax time. And I think a lot of my listeners is going to find Syed's information very, very helpful. Syed, good to see you again. Welcome back to the show.
Thank you, Kevin, for inviting me again. It's an honor to be on your show.
So, for those who didn't listen to our first webinar together, just briefly introduce yourself and talk a little bit about the story of the Wall Street Alliance Group.
Yes, Kevin. So Wall Street Alliance Group is a fiduciary advisory firm specialized in financial planning for physicians. My background is I came to US as a foreign student about 22 years ago from Bangladesh. And after graduation, I started my career as a stockbroker in a firm where I was to do cold call. In the same firm, I met my now business partner, Adil Zaman, who's from Pakistan, and we instantly connected. And we started reaching out the affluent first generation immigrant at the beginning of our career because of the cultural affinity and speak about the importance of financial planning in US. But when we're reaching out to them, Kevin, we realized we're getting a lot of physicians. The reason is because if you take a look at the statistic published by Journal of American Medical Association, 1 out of 6 physicians in US are foreign born. And these physicians have unique financial planning needs, such as tax planning, asset protection, practice valuation, contract review. And when we sat down and met with them, they don't want to just talk about investments. They want us to take care of all their financial planning needs. So what we decided to do, the best way to serve this physician community is becoming a fiduciary fee-based financial advisor where there's no product, no conflict of interest. And with this intention, we form a team of experts from CPAs, actuaries, and attorneys, and formed Wall Street Alliance Group in year 2010. So it's been almost more than 10 years. And now we have grown to almost 400 million asset under management. And now we are providing wealth management solution for physicians across the United States.
So let's get right into the meat of this subject, because a lot of physicians I know are doing their taxes and thinking about tax planning. So can you explain why tax planning is important for physicians, especially in 2022?
Yes, so tax planning is extremely important for physicians, Kevin. If you take a look, recently, Biden administration has just passed $1 trillion infrastructure bill. Whenever there's a big bill like this, always in the economy, there's a budget deficit. And the big question is who's going to pay for the bill? And most of the time, the simple answer by raising the taxes. And like it or not, the taxes overall for the last few years has been down. So the tax must go up. So there's a lot of bills out there in the Senate and Congress, and they're discussing about it. But so far, the overall consensus is people who are making more than $400,000, they will be impacted the most. Mm-hmm. Now, give you some of the provisions in the bill. Let's say if the income is more than $400,000, joint household, we're talking about, your tax rate goes up from 37% to almost close to 40%. You might be thinking, hey, it's only 3% jump. What's the big deal? But there's some more provisions in the bill as well, such as there's no Social Security tax we pay if the income is up to $140,000. But one of the provisions in the bill is because there's a big gap in Social Security. Any income more than $400,000, there's a provisions you pay additional 12.4% Social Security tax. It's a big jump. And also small business owners, they actually have itemized deductions. So if the income is more than $400,000, the deductions start to phase out as well. So that's why ideally, if it's possible, to have the income low. So when the bill get effective, most likely this year, you don't get, overall hammered too much with the taxes. No, it's a good time. That's why, like you just did your taxes, the physician should sit down with your CPA and financial advisor and come up with all the strategies possible. So they understand they are in control about their overall taxes.
Now let's talk about tax deductions. The tax filing deadline, of course, is April 15th. Now, what are some of the deductions physicians commonly overlook?
Yeah, so the first thing first, when you file for your taxes, make sure you don't miss the deduction, at least for the last year, 2021. And every year, Kevin, pretty much the deductions are the same for the last few years, at least the foundation. So since 2018, there are two types of deduction when you file for taxes. The Trump administration, when it came in, they pretty much doubled the standard deduction. It used to be around close to 12,000. Now it becomes almost about $25,000. So that means you can just claim $25,000 deduction as a standard deduction without showing any deduction. IRS allows it. But that's the problem with this is most CPA just taking this easier way out. They are just going for standard deduction. But hey, you may have some other deduction, like for example, donations. You may have some mortgage expenses. You may have some real estate that you haven't shown. Try to lump it together and see if you can go over the 25,000 threshold limit. So you can get more deductions, and that's more work for CPA, but definitely we see our physician client miss a lot of deductions. Now, what are the deductions we see physician miss all the time? First deduction we see, especially for self-employed physician, they miss something called QBI, Qualified Business Income Deduction. So QBI means whatever income you collect as a business, you can write off 20% of the business as a deduction. For example, if your income is $100,000, you can write off 20% of 100,000, which is around $20,000 as a straight deduction. That was passed a few years ago, still is applicable. There's a QBI similarly for rental income as well. So for example, if you have a rental income of $50,000 per year, after even depreciations and everything, whatever income is left, you can write off 20% of the rent as a deduction as well. So again, we see physicians miss rental income deductions as well. Now, before April 15, again, these are for self-employed physicians, you can open a SEP IRA. In a SEP IRA, you still have time for it. If you haven't filed for your taxes, you can write off 20% of your adjusted gross income or 58,000, whichever is less, as a SEP IRA, and this money is pre-tax. You can also open up a cash balance plan. In a cash balance plan for last year, you can contribute, let's say, over the age of 60, almost close to $260,000. And again, all money are pre-tax. But again, you have to sit down with the actuary and CPA and come up with the calculation. And a straightforward IRA, husband, wife over the age of 50 can contribute $7,000 each. And lastly, HSA. We see a physician miss all the time that if the employer allows you to contribute into the high deductible savings account, you can contribute $8,200 for the family. And again, hey, all the money are pre-tax. And the beauty is, if you leave the money until the age of 65, after 65, you can take out for non-health related reason as well. But again, you can still have time before April 15 to open all these IRA accounts to speak to your CPA about it. The next item is a student loan payment deduction. A lot of physicians think they don't qualify, but if your income is below about close to 140, you can write out about close to $2,500 of the interest you pay. A lot of students do qualify for it, and speak to your CPA about it. And then the real estate, if you have income, make sure that you write down all the expenses, all the renovation, all the depreciation. We see depreciation miss out all the time. The rental income become an expense. And last year, Kevin, as you know, due to pandemic, a lot of physicians transformed their business working from home. If that's the case, a certain percentage of the square footage of the house you can write off as a home expense deduction. So make sure you speak to your CPA about that if the business has transformed. And I want to talk about two more items, which is called research and experimental credit, which is known as Rnd Tax Credit. Usually my dentist clients, we see it all the time. If you have buying equipment that actually overall improves the service or overall improve the process, up to $250,000, you can get Rnd Tax Credit from your payroll. Again, you have time by April 15 to speak to your CPA if you have done any of the process or not. And lastly, last year and up to this year, the food expense for business is 100%. It used to be 50% of the amount you write off, but right now you can write off dollar per dollar up to 100%. So again, speak to your CPA, but I know that it's a long list of the small question you asked, but this could be a good foundation to sit down and speak to your CPA that if you haven't missed any deductions or not.
Now, I understand that better planning can be done if some of these steps are implemented at the beginning of the year. So for 2022, how can we plan to be better prepared from a tax planning perspective?
Yeah, for 2022, the good thing is that we're talking at the beginning of the year, a lot of things can be implemented that people have missed out last year. For example, 401k, in a 401k, if you have an employer sponsored plan, make sure you max out. For 2022, the amount went up. Husband and wife can contribute over the age of 50, almost $27,000 each in an employer's sponsored 401k. Again, all this money are pre-tax. And a lot of times there are match as well from the hospital. So for example, if you contribute, only then there is match. So at least contribute the amount, there's a match, unless you miss out. Also in a 457 plan is non-for-profit. This is where you can contribute, but there is no match. But again, you can defer the money. You can take this money out before the age of 59, and there's no penalty in it. 409A plan, these are a lot of physicians miss out in a 409A plan is similar to a 457 plan, but the contribution amount is almost goes as high as 90% of your salary. So the problem with the 409A plan compared to 457 is the money is not 100% principal guaranteed if the hospital files for bankruptcy. So we're not saying I'll put a lot of money into it, but again, if your income is very high, speak to your CPA. If a 409A, 457 plan makes sense for you. And as I mentioned in the previous conversation, cash balance plan, self-employment physician can contribute almost $260,000, but it depends on your wage. So this year you have the full year to adjust your wage, your salary. So if the salary goes down, contribution goes down, salary goes up, contribution goes up. So again, adjust now, it's a good time to do it. And it's a new law I want to talk about next, which is called a SALT cap workaround. A lot of states start to implement it. So far, about 20 states has started to implement it. When Trump became a president, the property tax you pay, the state tax you pay, the maximum you can write off is $10,000, which is called SALT. Now, states like New York, New Jersey, Maryland enacted last year that if you have a S corporation or C corporation, you can pay the same state taxes from the corporation and get to write off the full amount from the federal level. But it's not automatic though. You have to elect to do it. For example, in New York, by March, you have to elect for 2022, you want to pay the state tax from the corporation. But again, it's a big deduction if you have a lot of income from New York. So make sure you speak to your CPA, paying the state tax from the corporation to get the deduction makes sense or not. And then last two items is Roth IRA. Is the reason I put it there because we all know the market is down right now because of this Russian issue going on. So if the portfolio is down, it's a good time to maybe doing some Roth conversion, because the beauty of Roth conversion from a pre-tax IRA accounts, once you convert it into a Roth IRA, the money goes tax-free and the withdrawal is also tax-free, and you pay less taxes now because the overall portfolio might be down. And one of the provisions in Biden's tax law is Roth conversion may go away if the income is more than 400,000. So again, the Roth conversion is still there. It may be a good idea to do it depending on your tax situation. And lastly, if you are self-employed, this is for your children, you think there's a use for them, hire your children and put them into the payroll. It is just not about the money point of view, but you are educating them about the importance of money. They're working for you, have them work for you during summertime and pay them $5,000, for example. And this $5,000 they can contribute into a Roth IRA for the child. And the Roth IRA, the beauty is after 5 years, they can use it, the children, for buying a first-time house, education, and emergency expenses. They can take it out. There's no penalty in it. And the money grows tax-free. So these are some of the retirement point of view. Some of the strategies are available for physician. Speak to your CPA if it makes sense for you.
You're listening to a special sponsored episode of the podcast by KevinMD, Tax Planning Tips for Physicians. And we have Syed Nishat. He is a partner at the Wall Street Alliance Group. He can be reached at wallstreetag.com. That's wallstreetag.com. Syed, are there any other tax deduction vehicles besides retirement accounts?
Yeah, so beside retirement account, these are some physicians are saying, okay, I'm not self-employed. What other options are there? I have some outside investments. Yes, a lot of physicians invest into real estate. One suggestion we're saying to physician clients that if you're into real estate, try to invest into opportunity zone. What is an opportunity zone? It is into an area where there's a 20% property rate. Government is encouraging an investor to invest the money. The beauty of opportunity zone, once you invest the money into real estate into that area, leave it there for 10 years, there's no capital gain tax. Again, very powerful. Then if you need a car for the business, again, if you need it, if you buy a car weighing more than 6,000 pounds, for the business, you can get to write off the full purchase price for the car. Full purchase. So usually the 6,000 pound cars are expensive, $80,000 at least. You can get to write off all of it. Still there, most likely will go away. So again, the physician can use it, this year. Again, the 5 to 9 contribution, if you do it, you can get a state tax deduction. For example, New York, for my 2 kids, I can contribute 10,000 each. Again, I get some write-off for state taxes. And I put out this information, tax harvesting, because the market is down right now. If you have a significant profit, some stock might be down right now, book some losses. So offset the profit you may have it. And then cost segregation, I think it's one of the most underutilized strategy for physician. Most real estate you own, Kevin, for commercial, the depreciation schedule is about 39 years. What is depreciation? It means every year the depreciation happens, you can get to write off from the rental income you collected, so it's a wash. Cost segregation study, all it does is bring the depreciation down from 39 years to 5 years. So that means you get a bigger depreciation and you can get to write off a huge amount of losses against your rental income you collect. And I was talking to a physician client of mine in Texas. He has a urgent care. We bought it, and it's for $1 million. And we did a cost segregation. We get immediately $250,000 advanced depreciation. In the 35% tax bracket is almost $87,000 tax saving right there. So again, if you're into real estate, speak to your CPA about cost segregation study. And lastly, I want to mention about charitable contribution. There's no way in this podcast I can cover it because charitable contribution could be podcast of its own. But just to give you an idea, we see physicians all the time give cash. It's a mistake though. Don't give cash because if you have appreciated stock, give it the stock though as a donation into a donor fund. Let's say you bought Apple for $100, stock is $200. When you sell it, you have to pay taxes regardless. So the best thing would be just, if you're charity minded, give this Apple stock as a donation. The beauty is that the appreciation from 100 to 200, you pay no taxes, plus you get the deduction as well. So up to 30% of stock of your adjusted gross income, you can contribute before December. You can open into a donor fund and do it. So if it's interest to you, speak to your financial advisor whether charitable contribution makes sense for you or not.
Now, there are a lot of financial services companies that advertise to healthcare professionals like physicians and dentists. Now, tell us what separates the Wall Street Alliance Group from your competitors and why should physicians consider you?
Yeah, so 90%, Kevin, our clients are physician. And to answer your question, I'll share a personal story with you. I shared in your last podcast as well that, a few years ago, my wife was diagnosed with uterine fibroids. And as you know, fibroids are very common in women, especially South Asian women. But unfortunately, my wife had over 17 of them. So we went to a lot of general OBGYN, and the overall opinion was just to remove the uterus because there's a lot of bleeding she was going through. So we were overall hopeless and didn't know what to do till we met a physician who is specialized in fibroids. So this guy was all the way in Alabama. And when we met with them, he assured us that he had the team of experts we needed in-house. So we don't have to go to 10 different places. He does this surgery day in, day out. He knows what the problem is, and he made us feel very comfortable. And he was a miracle doctor for us because he was able to do the surgery very seamlessly. And because of this miracle doctor, it's been 5 years. Now we have 2 kids, Ayan and Noah. And the reason I share the story with you, because if we haven't found this specialist, we still would be probably going to, rambling through the process. And so the moral of the story is that whenever a physician go to a financial advisor, make sure the financial advisor is an expert in something, like my physician was expert in fibroid removal. So we don't have to really worry about this. Make sure that the financial advisor has a team of experts like my physician's client did. So the physician don't have to go to CPA and attorney to 10 different places, and make sure the financial advisor the physician choose are fiduciary, like this physician was a fiduciary for us and save our lives. And we believe that we have the team of experts, physician in-house, and we can take care of all their financial planning need under one umbrella very efficiently.
Syed, what are some of your take-home messages that you want to leave with the KevinMD audience?
Yeah, so one take-home message, Kevin, I will have it that we're talking about tax planning. And this is one of the important topic of financial planning, but not all. One of the concerns we have we physicians have a lot of blind spots and they're not focusing on it. Like we're seeing a lot of young physicians coming to us with a very hot topic. Give us the best hot topic possible. How can you beat the market? That's the question they're asking. And that's why I want to use a financial advisor. It's a wrong question to ask. And think logically, Kevin, if I know how to beat the market, I don't need any physician's money. I'd be probably investing more money and become a billionaire right now. But that's not the case. The reason why you're using a financial advisor, because a physician, most likely one thing you don't have is time. You don't have time to do estate planning and go to an attorney. You don't have time to do complex tax planning and go to a CPA. You don't have time to collaborate with an asset planning attorney. So what we do, that we wear a hat of a fiduciary to talk to all these experts, and at the end we create a foundation for you, which is a financial plan. Without a financial plan, it's like you driving a car without any direction. You'll be driving aimlessly. So that's what a fiduciary financial advisor is supposed to do for you: create a roadmap for you, so your overall financial plan isn't intact. And this is what we do, and this is what the physician should focus on, which is creating a foundation, which is a financial plan. That is very important.
And how can people reach you?
Yeah, so Wall Street Alliance Group is not just only one person. We have a team of experts. You can go to our website, is www.wallstreetag.com. You can see all our team's bio. You can complete the questionnaire, and we'll be more than happy to get back to you with a complimentary financial plan.
Syed, thank you so much for coming back on the show, sharing your time and insight.
Thank you, Kevin, for inviting me again.